Welcome aboard. As a senior consultant here, I am absolutely thrilled to mentor you today. You're stepping into the role of a financial accountant. And to be successful, you really need to deeply understand the structural integrity of our financial systems. So, in this explainer, we are going to look at the foundational architecture of our general ledger accounts. Consider this your masterclass in SAP GL Master Data. Okay, let's dive right in.
So here is our roadmap for today's explainer. 1. The chart of accounts blueprint. 2. Account types and groups. 3. Guardrails for master data. 4. Creating and maintaining accounts. 5. Global consolidation and currencies. And finally, 6. Period end closing practices.
Starting right off with Section 1, the chart of accounts blueprint, which is literally the foundation of our financials.
Now, the chart of accounts. It sounds complex, right? But the definition is actually remarkably simple for something so powerful. Think of our operational chart, YCOA, as the master blueprint. It's essentially a variant containing the basic structure of a GL account. It features a simple 4-character ID, a designated maintenance language for the descriptions, and an account number length that can be anywhere from 1 to 10 digits. This blueprint absolutely must be assigned to every single company code that intends to maintain accounts, because without it, you have zero financial structure. Here's something you absolutely have to remember. A GL account is really a two-part entity. We're talking about the chart of account segment versus the company code segment. I like to think of the chart of account segment as the universal DNA. It holds the account number, the short and long names, and control fields that apply globally across the board. You only enter this once, but that account isn't fully usable until it's paired up with a company code segment. Think of the company code segment like a local passport. It grants the account local permission to operate within a specific region, controlling things like the local currency, tax categories, and specific house bank data. Both of these segments must combine to form a complete, active account. Moving on to Section 2, account types and groups, or basically how we organize the ledger.
Okay, so every single account you create is going to fall into one of 5 specific buckets. We have your standard balance sheet accounts and dedicated cash accounts, which, by the way, significantly reduce the number of GL accounts you'll need for bank reconciliations. Then we have non-operating expense or income for activities outside the main company purpose. And finally, primary costs or revenue and secondary costs. Those last 2 are incredibly important because they serve as crucial direct links to the controlling area. Secondary costs, for instance, capture value flows completely inside the organization, like your overhead allocations.
Now, as an accountant, you've got to internalize the contrast between balance sheet accounts and P&L statement accounts, particularly when we hit the closing procedure. Balance sheet balances carry forward to the exact same account at fiscal year end. P&L accounts, however, they are completely zeroed out and their balances carry forward to a retained earnings account. The system knows exactly how to do this because you will assign a specific key, often the letter X, to route those P&L accounts over to retained earnings. If you forget that key, your year-end close will fail and you'll probably be spending your New Year's Eve right here in the office.
Beyond just account types, we also organize accounts into account groups. I want you to think of account groups as zoned neighborhoods in a massive city. Just like a residential neighborhood has totally different building rules than a commercial zone, account groups dictate strict number ranges and data entry rules. For example, all authorized travel expenses might be zoned to only accept account numbers from AE00000 to AE99999. Furthermore, this neighborhood actually controls the field's status appearance when you are creating the company code segment, making sure that similar accounts share the exact same data entry screens.
That brings us to Section 3, guardrails for master data, enforcing audit-ready consistency. To keep everything audit-ready, we rely on some pretty strict system guardrails, mostly through field status controls. When you're updating master data, you are governed by a very specific hierarchy of rules. From highest to lowest priority, they are suppress, which hides the field entirely, display, which makes it visible but totally unchangeable, required entry, meaning you literally cannot save without filling it out, and finally optional entry, which has the lowest priority. When the system evaluates both your account group rules and transaction-specific controls, it is always going to enforce the rule with the highest priority on this list. So if one rule says optional and another says display, the field will be display. This is exactly why you should always test your field status settings in a sandbox environment before rolling them out to production.
So you might be wondering, with all these strict rules in place, how do massive volumes of customer and vendor invoices actually make their way from our subsidiary ledgers into our main general ledger?
Well, it all comes down to this one fundamental rule. Amounts cannot be posted directly to reconciliation accounts, period. Reconciliation accounts are honestly brilliant. They act as automated, highly secure bridges for subledgers like payables and receivables. When an invoice is processed in the subledger, say an accounts payable clerk posts a massive vendor invoice, the system automatically routes the corresponding financial value right through the designated reconciliation account to update the general ledger. This guarantees that our main ledger is always perfectly synchronized with the subledgers, completely removing the risk of manual direct posting errors.
All right, Section 4, creating and maintaining accounts, basically your routine consultant workflows.
As you settle into your role, you'll be creating accounts using one of three standard methods. First is the one-step method, where you create both the universal chart segment and the local company code segment simultaneously in a centralized way. Second is the two-step method. This is great when one team handles the global chart segment first, and later on, local accountants add their specific company code segments. Third is the copy method, where you simply replicate properties from an existing account. You'll use these daily, and hey, for massive organizational changes, you might even use data transfer tools like the migration cockpit.
But what happens when a new regulatory requirement drops and forces us to update attributes across dozens of accounts at once? You use collective processing. Using the Manage GL Account Master Data app, you can select up to 50 accounts at a time. You simply choose Mass Change, select the attributes, insert your replacement values, and hit Apply and Save. But hear me clearly on this. This workflow is incredibly efficient, but those changes have immediate, sweeping consequences across the database. Always double-check your inputs, and ideally, test the mass change on a small batch before you hit Save.
Let's look at Section 5, Global Consolidation and Currencies, because we are operating multinational. Okay, you really need to grasp how currency settings behave in SAP. If you set an account's currency to the local currency of the company code, that account is flexible. It will accept postings in any currency and automatically convert them to the local equivalent. However, if you explicitly assign a foreign currency to an account, it becomes highly restricted. It will only accept postings in that specific foreign currency. A common trap for new accountants is misconfiguring cash bank accounts. If you accidentally lock a US bank account to euros, the system will flat out reject any local US dollar postings.
Take a look at this matrix. It perfectly illustrates how we handle global reporting using a combination of chart types. We have our operational charts like YGOA for Europe and COUS for North America, where the daily postings happen. Now, if a country like Spain legally requires a specific numbering system, we map an alternate local number using a country chart. But for the board of directors to actually see the big picture, we roll all those operational accounts up into a single group chart, often called cons. This allows seamless external consolidated reporting across our entire multinational footprint. And finally, Section 6, Period-End Closing Practices, where we tie up all the loose ends. Before we even look at account balances, your very first daily routine step in a close is ensuring your financial posting periods are properly managed and locked down. A massive part of the close involves checking clearing accounts. For this, you absolutely must utilize open item management. A golden rule here. It can only be activated or deactivated when the account balance is exactly 0. It actively tracks whether an item is open or cleared. This is absolutely essential for bank clearing accounts, and totally vital for goods receipt and invoice receipt, or GRIR, clearing. It's the only way to quickly identify which specific business transactions still lack an offsetting posting before you officially close the books.
Remember that P&L distinction we talked about earlier? This is exactly where it pays off. You must ensure your P&L accounts are properly mapped to retained earnings accounts during configuration. If you use a single retained earnings account, the system automatically assigns it. But if you have multiple, you have to carefully select the right key. If you fail to maintain this, your balances will not carry forward correctly at your end, and your financial statements will be fundamentally flawed.
So as we wrap up this explainer, I want to leave you with something to really chew on. If a single field status error or a tiny misconfigured currency setting can completely compromise our global financial consolidation, how are you going to approach your very first master data entry tomorrow? Master data isn't just mundane data entry. It is literally the structural integrity of the entire business. I challenge you to treat every configuration, every mass change, and every account group with the exact precision of a master architect. Good luck, and again, welcome to the team.